Let's let the fun continue. We're now going to talk about whether we should accept a special order or not. So what is a special order? A special order is a one-time order that's not considered part of the company's normal ongoing business. So this would happen when a customer comes up and says, hey, I've got some situation here where I need a certain number of the product you provide. You know, if I order like this huge amount, can you give me some type of deal? And it's a one-time order and it doesn't normally affect the company's other business. So the question is, what price could I charge that would make taking on this special order make sense? So when analyzing a special order, we only want to figure out the incremental cost versus the incremental benefits. So how much extra is it going to cost me to make the items for the special order versus how much money am I going to get from the special order? The existing fixed overhead costs that aren't affected are not relevant, and if you include them, you're going to come to the wrong decision. Let's look at our example. Jet Inc. makes a single product whose normal selling price is $20. A foreign distributor offers to purchase 3,000 units for $10 a unit. This is a one-time order, won't affect regular business. Annual capacity is 10,000 units. Jet's currently producing and selling 5,000. So why do I give a shit about that? It means they got plenty of excess capacity to meet the demand of the foreign distributor. So should we accept the order? Well, some people might say if we sell them for 20, screw the foreign distributor, we're not going to give them for 10. But that would be a bad decision. We need to have more information to make the right decision. If I can make each additional unit for $8 and I'm getting 10 for each unit, I'm going to add to profit. Not only am I going to add to profit, but I'm also going to be able to keep my employees busier and allow them to make more money. So it could actually be a very good thing for the business. So let's look at Jet's financial information before the special order. So their revenue is 5,000 units. That's their current sales at 20. And then direct materials, direct labor, manufacturing overhead, and marketing costs that are all variable. Total 40,000. So if we take 40,000 divided by 5, that tells us our variable cost per unit is 8. So the 40,000 total variable cost divided by the 5,000 units gives us an $8 variable cost per unit. The fixed costs, manufacturing overhead, and marketing costs aren't going to change based on taking on this special order. They're fixed. They're not affected by volume. So those wouldn't be impacted. So the cost to make each unit is 8. If we get 10 from the special order, it's a winning proposition. So our incremental revenue is going to be the 3,000 units times the $10 selling price, and our incremental cost would be the 3,000 units times the $8 variable cost. So the financial advantage of accepting the order is 6,000. I would have done the selling price for the special order is 10 minus the incremental cost of 8 per unit gives me a difference of 2 times the 3,000 gives me that same 6,000. So I like doing things on a per unit basis, a little less math involved. Either way, you arrive at the same conclusion. So, of course, the answer assumes fixed costs are unavoidable and that the variable marketing costs are incurred on the special order. If it tells us otherwise in the problem, we would modify our calculation appropriately. But ultimately, we should accept a special order anytime that the incremental revenue is greater than that incremental cost. Just because we sell the product for more than the special order is offering doesn't mean that we should reject it. Just because we charge our current customers more than what the special order is offering doesn't mean we're not going to be able to improve our bottom line. So again, the focus here is on the things that are going to be different. So let's do a little quick check action, see if you're catching on to this stuff. Northern Optical ordinarily sells the X lens for $50. The variable production cost is $10, the fixed is $18 a unit, and the variable selling is $1. A customer requested a special order for 10,000 units of the X lens to be imprinted with the customer's logo. The special order would not involve any selling costs, but Northern Optical would have to purchase an imprinting machine for $50,000. What is the rock bottom minimum price below which Northern Optical should not go in negotiations with this customer? In other words, below what price would Northern Optical actually be losing money on the sale? There's ample idle capacity, so we won't be hurting our current sales. So give the video a pause. I'm going to go back to this slide with the data. And using this data, I want you to figure out what's the lowest price that the seller would be willing to accept in order to make this special order feasible. Welcome back. I hope you tried it on your own. Let's see. So we ordinarily sell it for 50 bucks. I couldn't care less what you normally sell it for. The variable production cost is 10, so that's going to matter. So that's going to be an incremental cost. It's going to increase. The fixed production cost is 18. I don't care about that, and I don't care about this variable selling cost because it told me I wouldn't incur it. It says the customer requested a special order for 10,000 units imprinted with the logo, and in order to do that I need to buy an imprinting machine. So there's going to be an increase in fixed costs of 50,000, and we're going to spread that out over the 10,000 units to figure out how much money I need to get back per unit in order to pay off that additional 50,000 cost. So that's $5. So when all's said and done, I need to sell these for at least $15 in order to make this additional order feasible for the company, in order to make additional profit, because my variable costs go up 10 a unit, my fixed costs go up by 5 per unit. So the answer here is $15. The other way to do it, if you're not going to do it on a per unit basis, is you can do it in total. So that's what they did here. The variable production cost would be the 10,000 units that the special order desires times the variable cost of 10 per unit. The additional fixed cost is the total 50,000 for the new machine. That gives us the total cost that we need to recover, and then divide that by the number of units to get to the average cost per unit. So for all these problems, there's more than one way to arrive at the right solution. You have to choose the way that makes the most sense to you. The focus, though, is on the items that change. What's going to change? Only the variable production cost is going to change, and the fixed cost associated with the new machine. The current fixed costs that we have are irrelevant because they won't change, and the current variable selling cost is irrelevant because the problem said we're not going to incur that. Which makes sense, because if you have a special order, usually it's because the customer reached out to you, so you're generally not going to have to pay sales commissions or something on that type of special order. But just read the problem. It'll tell us what matters and what doesn't. We just have to identify it.